Bergstro, welcome. You're partner at Deloitte, leading the enterprise technology and performances offering portfolio in Sweden. Nice to have you here. I would like to start off with a question for you. Based on your experience, could you mention a specific challenge that you faced with clients 20 years ago, which you can conclude is still a common challenge today? And why has this not been solved in that case?
Thank you very much for having me here. That is a very interesting question, and I think I will actually come into that in my presentation. But to be more a little bit specific, I think lots of organizations are they do have a challenge with relying on a static plan, meaning very much about the budget, and very many seek something different or an alternative, but it's quite difficult or challenging to find. And I think those type of challenges I faced 20 years ago, and I'm facing them still today.
Continuing. And I'm very interested to know, Robert, if you could have any superpower to help you in your financial career, what would that be?
That would definitely be a crystal ball as a basis for doing forecasting. That could be a benefit for your own from a private perspective, but also in business. If we would have a crystal ball, we would definitely get a strong competitive advantage to foresee what's coming. So I think that will be the superpower.
And most important question then, if you would have this crystal ball, would you share it with me?
Yeah, maybe.
Maybe.
Yeah.
Okay, perfect. And before I let you on stage, I want to remind the online audience about the 7 different deep dives that we have during the day in which you can join. And the first one is integrated financial planning, which is starting in 15 minutes. But before that, let's listen to Robert. The stage is yours.
Thank you. So 22 years ago, I think, I had a client engagement with a big automotive company on the West Coast. And we were working on trying to change the way of working, going from this having a static plan or a budget that everyone realized it was obsolete the same day it was approved, to an alternative model. And we were working on that for quite some time. And since then I've been working on the same type of challenges, not only in Sweden. I'm based in Asia, in US, and working around the globe with big multinational companies. And I think what is really common, I will share a little bit of, it's only a few minutes, so I can talk for days, but I will share a couple of challenges that will, as I see it, is key, and also some of the principles that I think is key also to moving into an alternative model. So this is Eisenhower. It was many years ago. Probably many of you have seen it, but I think it tells a lot, because this is a mindset thing. If you look at the plan, the budget, and that is the goal, to develop that and have an approval. And once it is approved, you celebrate and drink champagne. If that is the mindset, then it's clear is that it is about planning all the time. Then we need to have some references. We need to have leaders in the organization to commit to something. But that's where the targets and goals comes in. And that is a complete different number. This is just an example how wrong it goes if we work in a traditional way. This is an extract of a very traditional management report. You see there is an accounting structure. This is a breakdown of travel cost. You see the actuals and you see the budget value. And if I'm a business unit manager and I come into my manager and report this, of course, we will have a certain discussion, meaning that I'm overspending my budget. And that is, for me, it could be a valid discussion, but it could also be a complete irrelevant discussion. Because if you look at this alternative report, these are the same numbers. The difference here, the report is not based on an accounting structure. These are now driver-based. what is driving travel spend. And now we're on such a detailed level. Why should you have targets or goals or budget values as references on this detailed level? It doesn't make sense. Pure trend reporting is sufficient to maintain the control. And as you can see, we added some more numbers in here. This indicates that I'm actually growing faster than planned, which means I'm being more cost efficient. So the former picture is completely wrong. It's based on something that we came up with 10 months ago. So this is just a little bit an eye-opener. So going forward then, what is the alternative then? One important principle is that, and I'm usually calling it focus on what matters. Because focus on what matters does not mean that we come up with budget values on very detailed levels. It means that we come up with targets on what really matters, and what we can foresee are in line with our strategic priorities and how, in the way on how we will execute the strategy. Those drivers and the metrics that we measure those drivers are the basis for prioritization on how we should actually managing the business. And then another principle is to separate what I'm calling now the managing the business versus tracking and controlling the details. And that is one of the biggest, I would say, mistake that we do in a traditional budget, because we mix this up. We ask for a commitment from leaders in the organization to details, and that doesn't make sense. You don't get out the priorities and focuses out into organization, and you don't get a strong commitment either. And when you go into reporting, if you report actuals versus budget, it's a pure historical explanation. So it doesn't become action-oriented or forward-looking. So the key point here is to convert, you can say, the budget value into 3 different values. And this is not new. This has been around for many years. This is also the logic behind the Beyond Budgeting Roundtable, those discussions they are having and so. So it means that you have targets that articulates what we have to achieve. And ideally it should be an external perspective on that, what the market is actually expecting us. So I usually say for a public listed company, targets are already set. You don't need to negotiate and discuss those internally. I can help you to say what the targets we should be. I will come back to that. The second figure or number is then the forecast. So the forecast should be a best guess, true believe, what we actually believe, based on the current assumptions in the way that we operate today, what will be the outcome in X month from now. If we change the assumption base, okay, then we will have different outcome numbers. That's a forecast, not a base for negotiation or anything like that. And then you have the gap between forecast and target. That gap is what you have to close with action plans. And this is where the resource allocation process comes in. How you need to prioritize investments, how you would like to spend your money, how you would like to allocate your capital. It all boils down to what gaps we're going to close. And that resource allocation plan, you can actually, someone can or say that, isn't that the purpose with the traditional budget also? Yes. So that's why I never say that you have to replace the budget. The budget is still there, but we usually rephrase it to another name, or usually my clients or the clients companies wants to do that because it's the budget term is so wrongly perceived. But what needs to replace is the managing part. I usually say that the traditional budget as a management tool, that is the problem. And this is just an illustration of how the forecast would look like in terms of what we strongly believe the best guess are, and how we compare that to the targets, and we have action plans to close those gaps. This is how it could look like. This is just an example how a process calendar could look like from January to December when you run the different processes. But the target setting process is something that you need to run quite late in the year in order to have the latest and greatest as a basis for setting those targets. And then you run forecasts. Depends what type of business and industry you're in. But let's say in this case, you run it 3 times per year or 4 times per year. You run the forecast and you do the resource allocation planning process with action planning in a coordinated way across the organization. And then you have business reviews to focus on the variance bit or the gap between forecast and target. And now I'm talking about the managing part. The other purpose of maintaining the control of the details becomes a complete different story, which I will come back to in a few minutes. Another very important principle, when I talk about focus on what matters, and I said that I can, in a few hours with some analysis, I can say what the targets needs to be for an organization. And that is, to be able to do that, you need to come up with what I usually call an economic model. And this is purely mathematics. So you have the income statement on the top right. You have the balance sheet on the bottom right. And you have the key metrics for measuring. And it's just a pure mathematical formulas on how you go to return on invested capital, to the spread, and to the economic profit. And if you're a public listed company, we know there is a strong correlation between economic profit and total return to shareholders. So in my mind, why shouldn't we have this as a focus when we are managing our business? Because this is so powerful. And to set some little bit context on what I mean, we've taken an external perspective. So we had the 2 key drivers to return on invested capital, being the EBIT margin and capital efficiency. And here you can see the IC ones as return on invested capital. So if we then would like to do a shareholder analysis, we can look if you look at the top right corner, we can calculate the enterprise value, and we can calculate the future value. It's pure calculations. The variance is what we call future value. And from that future value, you can actually calculate what will that mean in expectations, in growth, in free cash flow year on year. And that one you can convert, going back to the previous slide. What will that mean on return on invested capital? Then we actually have, if we want to maintain our enterprise value, which means our share price, we need to meet that return on invested capital target. So here you can see a simulation. We had actuals from last year. We have our latest forecast. It's not good enough. Let's say that we need to reach the next level of return on invested capital. Okay, how will we then improve? Improve the EBIT margin, improve the capital efficiency, or in something in combination. And this is how we can simulate them and take us up to the right return on invested capital level. And then on the lower right corner is an illustration of a business case prioritization matrix. So whatever investments you would like to do, there will be some requests for funding coming up to a committee, whatever you call that in the organization. And there needs to be a decision and prioritization on what investments to focus on. All of those investments that you should prioritize needs to take that to the next level according to this. And you can create some reports and analysis, dashboards and so on to really show this in a concrete way. So this is also an example how you can then use the top-down logic. This is the target that we have to achieve on a high level, and then we break that down to different functions, and we break that down to different value driver areas and KPIs. And then we do the bottom up. Okay, if we want to reach a certain target on capital efficiency, and then we break that down to working capital, for instance, we break that down to, let's say, inventory. What inventory levels do we need to have in each of our warehouses around the world? And then we aggregate that information up and make sure that it meets the top down. So it's a pure simulation exercise. And this is something I did 20 years ago with a number of companies. But there are still lots of companies that have not developed this yet. So planning is everything, as I said. And I said it's a very much of a mindset thing, but it's also, of course, an operating model thing. You need to develop this type of capabilities in terms of processes and knowledge, and you need to have the enabling technologies to be able to support this. But this is a model that I've been working on a lot. And it takes you on the lower left corner. It starts from this strategy review, the external expectations, and that takes you into, if you look into the upper left corner, it takes you into a modeling capability. I'm not saying that this needs to be a physical function, could be a center of excellence or whatever, but I'm saying it needs to be a capability, so it could be located wherever in the finance organization. But that group, that capability, the purpose with that is to all time, on a continuous basis, model. And the assumptions and targets will then go into the business to the right upper corner, and then there needs to be an integrated planning exercise between the different functions. And as soon as you face an unplanned event or another type of constraint, it needs to go back to that modeling group again to see how can we now optimize. Because it is about to be able to optimize resource allocation, how we spend our money, how we do our investments, how we allocate capital. And that needs to be, in order to say that we can actually optimize that, we need to have this type of tools to help us with that. Now, finance needs to play an important role in this. It's actually we, as a finance people, that understands this, and we need to support the core business in this. And this is coming back to what I said. One key principle is to separate managing from tracking the details. And this is one way of showing how this could look like. So on the left-hand side, you have the finance business partner organization, supporting the core business in the key when it comes to managing the business, setting targets, developing forecasts, doing resource allocation. On the right-hand side, we have the tracking of the details. That could be done in a shared service center or a back office. It could actually be done with technologies as well. I think it was 10 years ago we built this in a cloud-based platform, an automatic tracking of details. So as soon as a certain cost went outside of threshold, it generated an alert email to the cost center owner. And of course, those thresholds needs to follow trends and so they cannot be absolute. They needs to be relative. And then you need to have a center of excellence to handle all the expertise, the more advanced stuff. Examples of those you can see on the bottom of the page. So to summarize, it is very much about focusing on what matters. Focus on executing strategies when it comes to managing the business. Have a focus on creating value, coming back to the economic model that I showed. And use budget values for tracking and controlling details, not for managing. Take an external perspective, we talked about. View business performance management as an enterprise-wide capability, extremely important. It's about managing the enterprise performance. It's not about managing the performance of the finance function. Quite often I come to clients and they have set up their project organization and steering committees and stakeholder and so on, and it's all about finance people. But this is the business. So that's very important. Separate processes of the targets, forecast, resource allocation we talked about, and aim for management simplicity. That is why the finance business partner needs to come in and making sure that we can support in the right way to the core business. The process needs to be integrated. We hear more about that later today. And the operating model part, you need to look at this as a full operating model or capability. It's not just a processing or a tool thing. Yes, and the finance business partner to play that role and the center of expertise. That was it. Thank you very much.